This has been one of the strangest Bitcoin bull markets ever. It's the year after the halving, a period that's historically delivered parabolic runs and euphoric tops. Yet, this time, something feels off. Prices have refused to explode like before, even as institutional demand reaches record highs. Analysts and investors are scrambling for answers. Some blame global uncertainty, wars, tariffs, tightening liquidity. Others point to Wall Street giants like BlackRock, quietly soaking up supply through Bitcoin ETFs while keeping prices suppressed for their clients to buy cheap. And now, a new theory has entered the mix, one that's spreading fast across X, that Bitcoin OGs, the earliest holders from the 2000s, are finally cashing out, dumping their long-held stashes into this market. But not everyone agrees. Experts like Willy Woo and PlanB, two of the most followed on-chain analysts, are calling these claims flat-out wrong. We will explore both sides of the argument in this video, as well as valuable insights about the true big picture from Real Vision CEO Raoul and Strike CEO Jack Mallers. Before we dive in, make sure to like this video, subscribe if you love data-driven crypto analysis, and drop your thoughts in the comments below. Do you believe OG whales are really dumping? Or is something deeper happening beneath the surface? Thanks, and let's dive right in. Let's start with the speculation about OG whales. A recent tweet from Charles Edwards, co-founder of Capriole Investments, ignited the conversation. The tweet reads, "OG Bitcoin whales are dumping." This chart gives a good visual of how many super whales are cashing out of Bitcoin. All lines here are 7+ year on-chain spends from pre-2018 era OG Bitcoin hodlers. Orange equals 100 million OG dumps. Red equals 500 million OG dumps. The chart is very colorful and 2025 OGs are cashing out. The chart that accompanies Edwards' tweet points to significant on-chain activity from early Bitcoin holders, wallets that have been dormant for over 7 years, now suddenly moving large amounts of BTC. The implication is clear. Those who've been here since the early days may finally be taking profit, and that could be weighing down the market, but he isn't the only one noticing. Fidelity Digital Assets Vice President of Research, Chris Kuiper, echoed a similar concern in his own thread, writing, "Who is selling is the #1 question I've been getting regarding Bitcoin's continued price pressure against a backdrop of visible buying by ETPs, corporations, etc. I'm not unique in suggesting it's the long-term holders or hodlers. But one data point that gives more color is the simple metric of percent of coins active 1 year or more. As you can see in the chart below, this line goes up during bear markets, more holding on as coins age and people are sitting on losses, and then usually a dramatic decline as these longer-term holders sell into the strength of a bull market. What is interesting with this cycle is the relatively gentle slope down with this bull market. It didn't plunge when new highs were made. It's a consistent slow bleed as the market has slowly moved sideways and up, so instead of a sharp sell-off, Kuiper sees a slow, controlled distribution, more psychological than panic-driven. People expected fireworks, but Bitcoin hasn't delivered the euphoric top they were waiting for. The rest of his tweet reads, "Bitcoin's performance has recently lagged gold's, even the S&P, and people are getting tired. Everyone was expecting a euphoric end to the 4-year cycle and was waiting to sell into the historically strong seasonality of October and now November. But as October's strong seasonal pattern didn't hold up and the calendar year is coming to a close, long-term holders are looking to make year-end tax and positional changes, calling it a day with the gains they already have." Kuiper's analysis paints a more nuanced picture. Not a panic dump by OGs, but a slow rotation. Holders who've been patient for years are gradually taking profit as the macro environment remains uncertain and enthusiasm fades. But that's only one side of the story, because Willy Woo and PlanB don't buy it at all. Both analysts have shared data suggesting the OG dump theory might be completely misleading, and we'll get to that next, before Raoul's take flips the entire discussion toward what he believes is the real driver of the market: liquidity. So while some analysts believe Bitcoin's sluggish performance this cycle comes down to old whales dumping, others say that narrative is completely wrong, and the data proves it. No one has been more outspoken about this than PlanB, the anonymous creator of the Bitcoin stock-to-flow model, a framework that's guided investors through multiple bull markets. PlanB tweeted, "I see stories about old whales dumping Bitcoin, but the data does not support those stories." Almost 7 million Bitcoin transacted on-chain in 2025. Most BTC came from 2024 transactions. One big $84,000 Bitcoin 2011 whale, and some 2017 to 2023 sellers. But that's it, business as usual. In other words, PlanB's data shows no widespread exodus of early holders. Out of nearly 7 million Bitcoin moved on-chain this year, almost all of it originated from recent cycles, primarily from 2024 transactions. Only one major movement, roughly 84,000 BTC from a 2011-era address, stood out, and even that isn't enough to suggest mass selling from the early days. For PlanB, this is just another case of sensationalism meeting surface-level analysis, stories catching fire faster than the facts can keep up, but he didn't stop there. In a follow-up tweet responding to a question about Bitcoin's recent price dip, PlanB offered his view on who's really selling. "In my opinion, sellers are 2024 buyers that bought between $60,000 to $70,000 and are now taking approximately 50% profit around $100,000 price levels. Most of these 2024 buyers are probably traditional, non-crypto investors that bought an ETF, and for whom plus 50% is spectacular return. They probably moved on to AI." This theory reframes the entire conversation. According to PlanB, what looks like OG whales dumping is actually new money exiting early. Institutional and traditional investors who entered through Bitcoin ETFs during last year's rally. For them, a 50% gain is impressive enough to cash out and reallocate to the next big trend, namely AI stocks, which have dominated 2025's market narrative. Essentially, PlanB's argument suggests Bitcoin isn't being dragged down by old money leaving, but rather by new money rotating. A far more ordinary and less alarming phenomenon than people think. And to reinforce that point, Willy Woo, one of the most popular on-chain analysts on X, added crucial context explaining why this OG dump narrative might be fundamentally misunderstood. Woo tweeted, "Some on-chain nuance here. What constitutes an OG dump is simply Bitcoin moving out of an address that has been untouched for 7 years. Hence, Bitcoin looks resilient under heavy selling when in fact it's not necessarily all selling. Here are some activities that would be misread as a dump. Moving from an early address to a taproot address to be more quantum safe. A custody rotation. Signum official is on record saying OGs are posting their coins with the bank as a safeguard to wrench attack. Also posting as collateral to borrow against. Seeding a Bitcoin treasury company. OGs have been invited to participate in these. These typically are structured to bring in the cost basis and not trigger cap gains. It's not a sale, but a move to an equity wrapper." Willy Woo's point is critical. When coins move on-chain from old addresses, that doesn't necessarily mean they're being sold. Some OGs are upgrading their security setups, moving to taproot addresses that are safer against quantum threats. Others are transferring coins into regulated custody, like Swiss bank Signum, to secure them against physical coercion or to use as loan collateral. And in some cases, early holders are restructuring their wealth, contributing Bitcoin to new treasury entities or funds, often for tax and legal optimization, not liquidation. So while blockchain data may show these movements as 7-year dormant coins now active, it's a leap to conclude that it's all sell pressure hitting exchanges. Taken together, PlanB and Willy Woo offer a consistent counter-narrative. Yes, coins are moving, but no. That doesn't mean Bitcoin's early adopters are abandoning ship. The real story might lie elsewhere, in how liquidity is flowing and where the new demand is coming from. And that's where Raoul steps in, linking Bitcoin's price stagnation not to OGs or ETFs, but to something much bigger. Global liquidity cycles. After dismissing the OG dump theory, the conversation among top analysts has shifted towards something much bigger: liquidity. Because in every market cycle, from equities to crypto, liquidity is the invisible force that either fuels rallies or suffocates them. And no one captures that dynamic better than Raoul, CEO of Real Vision, who summed up the mood perfectly in a tweet that's equal parts frustration and perspective. Raoul Pal's tweet reads, "So it appears crypto markets liquidated anyone with greed and now want to grind down anyone with hope." Yup, it's been frustrating, and this grind is longer than expected, but it is what it is, and this too shall pass, and the spice, liquidity, must flow. Don't this up. Pal's message hits at the emotional core of this market cycle. He's essentially saying the crypto market has already washed out the over-leveraged and over-optimistic traders, yet continues to grind sideways, testing the patience of even long-term believers. But beneath that frustration is a key insight. That liquidity, or the flow of capital through the global financial system, is the missing ingredient. When liquidity tightens, through higher interest rates, quantitative tightening, or weaker credit conditions, risk assets like Bitcoin suffer. When liquidity expands, everything rises. In Pal's words, the spice must flow. Without that spice, even strong fundamentals and institutional demand can't push prices higher. In the same vein, Jack Mallers, CEO of Strike and one of Bitcoin's most outspoken advocates, believes the focus should remain on one thing: fiat debasement. One of the Strike CEO's most recent tweets reads, "There's only one move governments and central banks can play: print the money. They're issuing stimulus checks, and I'm supposed to be bearish. Bitcoin is the best expression of fiat debasement. I'm a simple man. If they have to print money, Bitcoin has to go higher." Mallers' argument is pure first principles Bitcoin thinking. To him, it's not about timing liquidity cycles or tracking macro data. It's about monetary inevitability. Governments always end up printing to solve their problems, and every new wave of money creation erodes the value of fiat while strengthening Bitcoin's long-term case as hard money. Recent price movements notwithstanding, Mallers believes this is the perfect setup for Bitcoin's next price explosion. In his view, stimulus and deficit spending are not threats, but triggers, precursors to the very debasement Bitcoin was built to resist. And that's what makes this moment so fascinating. Even among the smartest voices in the space, from PlanB's ETF rotation theory, to Willy Woo's on-chain nuance, to Raoul Pal's liquidity grind, and Jack Mallers' monetary inevitability, each sees a different piece of the same puzzle. So, who's right? Are Bitcoin struggles this year the fault of patient OGs cashing out, institutional rotation, a global liquidity squeeze, or just another quiet accumulation phase before the next parabolic move? As always, the data tells one story, the analysts tell another, and the truth unfolds in real time. And tell us in the comments, which camp are you in? Willy Woo and PlanB's business as usual, or Jack Mallers' money printer go brr? Or are you only interested in watching the whole thing play out in real time? If you enjoyed this breakdown, hit like, subscribe, let's get the conversation started. Thanks for watching.